Talking Point. I'm your host Neeraj Shah, and at times like these, when you would believe that the only certainty might be volatility, it pays to hear experienced voices about how they are approaching the investment landscape in such a. And our guest today is one such veteran. He's traversed many roles, and for the last few years, if you will, Atul Suri manages and rather successfully client money at his own firm, Marathon, of which he's a CEO, and he joins us right now to talk about how is he looking at the current landscape. Atul, great having you. It's been a while. Thank you so much for joining in. Hope all is safe.
Thanks, Neeraj. It's so nice to speak to you again after so long. And yes, markets have been kind in the last 1 year, and fortunately, even the health side has been okay. So fingers crossed. One of the few, I would say, lucky people. Bless our stars.
Yeah, indeed. Bless our stars. But Atul, let me ask you if not that any single month is devoid of volatility, but just the quantum of events and the news flow that we're dealing with right now seems to be as high as it has been in the last 18 months at any given point of time. How are you approaching this current landscape from an investment perspective?
No, I think it's very true what you say. And more so, we are heading into an event in the next 1 to 2 days. See, we must realize that post the 2008 financial market crisis, one of the big fuels for global equity markets and most of the asset classes has been easy money. And of course, Fed has been instrumental in that. From time to time, there are reality checks. You wonder rate hikes, tapering, etc. But I think now because the way inflation has been spiking up and it's becoming a serious reality rather than the word transitionary, which was used a few months ago, it seems to be more structural. I think this is something which would get the Fed to move. And as I said, we are heading into a meeting that's there in the next 2 to 3 days. And this, I think, will be very, very important. From time to time, we've had issues about certain stocks, certain sectors, etc. Those are ongoing stories. That's what make markets. If you don't have those stories, you won't have markets. It'll be just one straight line. But I think one big global macro, one big driver of markets, and whether you like it or not, for whatever there is in the fundamental universe, economics or the economy or company specific, it is ultimately money that drives markets. And today, what we are talking about is that issue, that single point, which is liquidity. Now, what stance the Fed will take, and based on what its stance is, how will market reacts? Nobody knows. But as you rightly put it, that we are entering a point where there are some very, very important news in the offing. And that is what explains the volatility. Of course, you can throw in a curveball. You have Omicron, how much it spreads, what fatality, how much is noise, how much is reality. So those are things which will never have perfect answer. But for me as an investor, I think the key thing is liquidity because I have seen, since a decade plus, the thing that has pulled through all challenges that we've had, and we've had multiple challenges. I mean, we had one of the biggest risks to humanity, or once in a or even a generation in multiple generation event with this whole thing. But we were able to pull out for me. So for me, last year has been a great learning. I mean, when we fell during COVID, if someone had given you even a 10-time odd that, well, a year later we'll make a lifetime high, nobody would have taken it. And so since that way, markets always teach, they humble, and that brings about learnings. And I feel that again, liquidity stance of Fed is very, very important for the longer term health of the market. And hopefully we should get a little more clarity in the few days. It's never going to be perfect. It's never going to have perfect answers. But yes, something is coming to boil in the next few days.
Atul, I get a sense that maybe markets the world over are thinking about the next year as a year of policy, seamless policy continuity, if you will, and hopefully businesses returning back to normal post the global supply chain issues. Now, none of these two are a given. Therefore, my question is: do you reckon that there is a higher probability of, or maybe it makes sense to stay on the sidelines currently as opposed to try and be extra active in the market, both from an investment or a trading angle?
I think there is a point in that, and we've done some work. So essentially, last year was a dream run. The market went up 140, 150% from the bottom. And you ask yourself that, hey, how long can this happen? Is it abnormal? Is it crazy? We hear all these terms. So what we decided was we went back and analyzed all big market crashes. So in our lifetime, with where we have good data, there were two. One was the 2000 IT bubble bust, in which the market fell almost 49%. And then we had the 2008, which was financial market, where the market fell 65%, right? And even this time we fell 40%. So if you really straddle the last 12 to 15 years, these are the three major, I would say, crashes that we've had. So what we saw in 2000 was that, well, the IT bubble burst, the market fell 49%. However, in 2003, you had a action which is like a spring that gets compressed. And the moment you release the spring just goes up vertical. So from 2003 to 2004, in 9 months, the Nifty went up 120%. This is between, I think, May of 2003 till something like maybe, Jan, Feb or so of 2004. So in 9 months, we had a market that was up 120%. So whenever markets fall, the first thing is that you get very, very oversold and it leads to a sharp rally. So if we are up at 148%, but you should also remember that the time taken is 18 months. So it's not that we haven't seen it. Then we went and analyzed that, hell, you can't just continue with this action forever. So what happens generally after this kind of spring action? Then we realized that the market actually for 15 months went sideways. Of course, we had a fall in 2004. There were some political reasons. Reasons are anything. They can manifest, whether it's Fed or whether it's politics or geopolitics. Nobody knows. Nobody can predict these things. It's a virus. Who knows? But for 15 months, the index did nothing. So the fact is that we had a 9-month pullback, but in 15 months, after 15 months, the index was minus 6%. And post that, you had the next stage of the rally, which took us from 2005 till 2008, which was, I think, another very, very big bull market. So markets really have three stages. The first stage is what we call the oversold rally, which is exactly what we've experienced. That the stocks and sectors which were beaten down the most were the best performing. Now we say, okay, this is one data point. Let's go to the next big crash. Let's go to 2008. The markets fell 65%. You had your financial market crisis, you had Lehman Brothers, instrumental in that. And post that, again, you'll realize that in 2009, you started a bull market. And let us now study that. In 21 months, right? Remember, we are 18, 19 months. In 21 months, the market went up 180%. So the fact is that, again, you saw the spring action. So what we saw last year is not something new. This is a typical behavior of the first stage of the bull market. Okay, that's gone. Question is, what now? So you will realize that from 2009, when the market sprung up, 2010, then we went in for almost a 35-month consolidation. That's almost 3 years. So the thing is that post that, again, the market rallied and came all the way till 2020, where we made a new high. So what I feel is that we are getting into that stage of a market where we will consolidate. So I call this, to use a Hindi movie term, kabhi khushi, kabhi gum. कि जब लग रहा है कि you're going to have a breakout, things disappoint. And when things get really disappointing, markets take up. So you really never have that ease of movement which you see in a runaway bull market or a bear market.
Yeah.
So now the question comes that, as an investor, if we are getting into a sideways market, which may last a year, we don't know, nobody knows, then what's the need to be in equities as an asset class, right? Why not sit out and chill? Because in a sideways market, you very often get the wrong hits. So we went and actually analyzed the NSE 100 at that stage, because the NSE 100 also is a very dynamic index. So we realized that in 2004 to 2005, that 15-month consolidation, out of the 100 stocks, where the index had done minus 6%, 70 out of the 100 stocks were positive, and only 30 were negative. So even a sideways market can make you return.
Wow. Okay.
And there were many stocks that were up more than 100%.
Wow. Okay.
Similarly, we went back in 2009 and 10, and we again analyzed. Of course, this time the ratio was not so flattering. It was a 40 advances, 60 declines. But net, what you realize is that even in this phase, there are trends. So for me as a trend investor, my learning or my strategy, which I ultimately drill it down to, is that even in these stages, you will see trends. So at an index level, at a headline level, for majority of investors, it will be a market which will not be too rewarding. If you look at the last already 1 or 2 months, it's not been rewarding for investors. And for a lot of people who were trading in a certain segment of the market, you'll realize that it's been very difficult. And leave alone India, if you go to the US, the US markets are not far from lifetime highs. You will see that a lot of marquee names and stocks have got battered blue. One of the most iconic fund manager, which is ARC Innovation Fund, Kathy Wood, if you see the
Yeah.
kind of performance. So they have been stellar 2020. But so even consolidations or even sideways market, you'll realize ke kabhi khushi, kabhi gum. And the whole market will actually diverge.
Yeah.
In 2020, everything went up. In
True.
fact, the more beaten down a sector or stock was, the more it went up. What were the best performing sectors of 2020, which were decadal underperformance? Metals, PSU banks, real estate. And mind you, they had done nothing from 2008 tops. 2008 tops were it. So it was almost a 10 to 12-year bear market. And these became the best sectors. So that is the specific, beaten down rally that you have. But I think now the market will bifurcate. You will have some sectors and stocks doing well, some will not do well. And that's where the whole thesis or premise of what we do, which is identify trends. And even in sideways market, there are trends which we shared with you statistically. And even there, we feel that there are opportunities to go out and create wealth.
Super. We'd love to talk about that, but just a quick process question, Atul. I've seen so you've had this history of being this very successful and renowned um, uh, person who looked at charts so successfully, and now are marrying fundamentals to it. I've seen numerous examples. You and I both know of very high money managing fundamental managers who are now making the use of charts as well to identify breakout points and trends, etc. What are you doing currently, Atul? Are you marrying the two, or are you now relying a lot more on fundamental trends as opposed to charts? How are you approaching this now?
So, Neeraj, we are trend investors. So, essentially, our aim is, our understanding is that what ultimately creates charts, what ultimately creates prices is numbers, is earnings. Whether it's an economy which defines the overall market, the macro direction, or whether it is sectors, when many stocks in a certain sector do well, you have a sectorial trend, or it is individual company wise. So what we really do is try to identify those companies which had longer term trends. A trend is for everyone is a relative term. For a day trader, a trend is 1 hour, right? For somebody, it's 1 week. For somebody, it's 1 month. But we are one of those rare trend investors. We believe in 3 to 5 years kind of stories. So we try to identify stocks that have earnings which have been trending. We are not the first to buy them, but the potential to actually run multi-year trends. And again, through statistical work, we realize that most alpha or most outlier performance happens when you identify some themes, whether it is the IT of 2000 or whether it's infra and real estate of 2007-8, or whether it is banks and financials that happened from 2015 to 2020. So there are always certain themes or trends that happen. And our job is to actually identify these themes and trends. And that is really our specialization. So the driver that comes is from earnings. So always our first filter is about earnings. But when we run a filter on, I think, about 2000 NSE stocks, we just come down to about 100 odd stocks, plus or minus based on quarterly numbers, things change. However, the important thing is that we use technicals for the discipline of entry and exit.
Okay.
Because very often we as fund managers fall in love with our stocks. and falling in love with stocks, because nothing is perpetuity. Nothing is perpetuity in our market. We've seen the mightiest of them fall. And it is this discipline of entry and exit is where the whole area of using price and markets directions that come in. So we are ultimately, our portfolios are sum total of about 20 to 22 stocks, high quality fundamental names. But most important is however high quality a stock may be, however great a stock may be, for an investor to make money, it has to reflect in the stock price.
Sure.
And there the emotion element comes in.
Sure.
Conviction, emotion, love, themes, great stories. We don't believe in all that.
We don't believe in all of that.
We believe that as long as you reward investors, however great your marquee name you may have, but as long as the trend is with you, the investor makes money. If the trend goes away, however good a name you are, whatever your pedigree is, it doesn't really make money. And a case in point is ITC. We like to talk about it very often, but really, I will tell you, for people who've been in the market, it was a time when, like, the star, I mean, that is before the Reliances and the Levers of the world, was ITC. In fact, ITC used to almost have 50% of market volume at one stage. It was such an iconic name. But you realize that when it loses strengths, and even today, if you look at it fundamentally, I mean, it's immaculate. Great business, all the moats are there, blah, 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 everything is there. But what does it mean for me as an investor? Nothing. What has changed is trends. The trend is not there. So we are trend investors. And that is how we marry fundamentally good stocks with very good entry and exit disciplines based on prices.
Very interesting. Let me try and quiz you on a few, and then I'll ask you for what finds favorites with you. Though I know that you like IT, and I have a couple of cross questions on that as well. But first, Atul, 2 or 3 pockets which came out winners sometime in 2020.
Yeah.
Metals, or in certain cases, they lasted for the last few years, specialty chemicals, for example. So, what about the winners of the last 12 to 18 months? Have you seen the trends change in any of those themes? Metals, real estate, specialty chemicals, and the whole API theme as well. So I'm throwing 3 or 4. Just pick and choose and tell us what you think about them.
So one is specialty chemicals. It's actually our top holding in our portfolio. We are disproportionately large compared to the benchmark or what other funds also have. What we saw in specialty chemicals, and this is not we picked up now, we picked up a couple of years ago, is that here was a sector which was little researched, little known. There were most mid-cap stocks actually in this space. But the kind of earnings that was being exhibited was very, very consistent. And this has not happened last 1 year, 2 year pre-COVID. This is almost since 5 years. And then you really go down below the hood and realize that here is actually a structural theme. The whole China plus one theme we talk about, the first sector actually to sweat it out and really play it out was specialty chemicals. And you saw along with it the price trends, which is again, as I said, marrying the fundamentals with the technicals was outstanding. Whenever markets corrected, even in the COVID fall, you'll see that all specialty chemical stocks corrected much less than the market. So for us, this is a typical recipe, and we think that this is something which is not a case of, they've corrected in the last, I think, 3 months or so. It's not about a question of a quarter or so. Yes, margins have got compressed due to raw materials, but we feel that the theme is much, much bigger. And we feel it will play out to be a larger trend. And even if we are wrong, we have the discipline of exits, because we all will make mistakes. No stock is still perpetuity. So assuming they do not perform beyond a point, well, I guess we always have the discipline of exit, which is something we are very confident about. We may miss buying something, but when things go wrong, we never miss selling anything, because we find that the Waterloo of all investors is ultimately an inability to cut losses. And that is something which I have learned in my life. And I think that is something which is no compromise, no negotiation. That is something which is important for survival. The market's kind. If you survive in this market for long enough, it will reward you. But through the journey, we've seen so many people never not been able to complete the journey. And that's why we view running our portfolios like a marathon. And that's where the name marathon trends come in, rather than a sprint, which is about making the best returns every week, every month. which is something we find doesn't sustain in the long run.
Got it. What about metals, Atul?
So metals is also a very interesting theme. Now, again, for a trend investor, being a commodity, it tends to have its volatility. However, there is nothing that is do not touch. If the earnings come and if you have price trends, who knows? Nobody knows the future, Neeraj. We all, all these things are, and especially the COVID, what should teach us or humble us that for whatever our knowledge or whatever our understanding of history, these markets are humbling. New things are thrown to us. The important thing is to continue with the discipline. So we find metals also very interesting. Maybe it's the early phase, and I said that we are trend investors, so we wait for something to play out. But if the earnings are consistent and we feel that it can play out in a longer theme, and of course the prices are showing us, there's no reason that why we would not be in that sector. At the moment, we are not there. But as I said, that nothing is a red flag for us. Show me earnings, show me prices, and I'm there. It's as simple as that. And if
Okay.
you don't perform, more importantly, I will have no second thoughts of
Exactly.
exiting.
Yeah, get your point. I've gleaned from some of your other conversations, Atul, that you are overweight, bullish, whatever term you use, on information technology. Now they are showing numbers. The company managements are talking about growth being visible for the next 2-3 years at least, if not longer. But they all say candidly that 3 saal ke aage kisne dekha hai? So 3 years or so. But 2 days, 3 days ago, I was talking to Nilkan Mishra of Credit Suisse, who is underweight IT. And when I asked him the reason, he said that one key factor would be what the added manpower attrition and the costs and the risk to that attrition has in store in the next 2-3 years, because IT services personnel are demand not just in IT services firms, but companies across the world. And therefore, you will have this problem which could impact the margins and the earnings for IT companies. And the growth, he believes, will not be more than 10-15% at best. Now, the argument is right there also. The argument is great in the camp of people who believe that some companies will grow 15-20% also. Where are you in this argument, and why are you bullish IT?
So we think that honestly, there are a lot of variables. One is how the manpower scene plays out, how the global demand plays out. And as I said that, we've learned over time that it's very, very difficult to predict all these variables. For important thing for us is that we are trend followers in that sense of the term. We are not trend predictors. And we may be a quarter late, but we are definitive in action, whether we buy it or we sell it. So we really do not invest based on, well, what is going to happen in the manpower area. It may work out, but some other variables come up. So we find that in our markets, for any sector, stock, overall markets, the variables are so much. And to get our head around all variables doesn't really work. We don't have any algo or we don't have any model that can factor in anything.
That's
The
true.
thing that we factor in is two things, is demonstrated earnings. Is actually what are you giving me? Show me the numbers. Even managements may be bullish, managements very bearish. Honestly, I don't care. Because you have to rarely meet a management which is negative on its own stock. So the fact is that whatever they say is fine. But the important thing is show me the numbers. And that also gets reflected in prices because the market is also very smart. If we think that the market's foolish, I belong to the camp that the market is very smart. In fact, I think the market is smarter than me. And I have to understand, learn, and follow the markets. So from what I really see is that IT stocks have run up. They've really deviated a lot from the mean per se, which is the index really. And they go in, just like specialty chemicals, they go in phases of consolidation. They may go in for a bit of correction. But I feel that IT and specialty chemicals are much larger trends. And we continue to be overweight those sectors. However, in case we are wrong, the earnings will prove it, the markets will prove it, and then we are disciplined enough. So we really don't get into predicting because we find that even managements cannot predict their own companies.
That's true.
We run a business. If you ask me to predict next quarter numbers, I have a sense, but how good am I at predicting? So I really sort of am not in the very big prediction game. I'm very clear that show me the numbers. I may be a quarter late in buying or a quarter late in selling. But when the journey is 3 to 5 years, I'd rather be more definite, sure, and more uh, disciplined in my action rather than be first or be last.
Okay, so just one quick follow-up, and then I would want to ask you a couple of questions on the other trending pockets, and then a final question on the index. We haven't spoken about the Indian markets per se. But Atul, one very quick question. You have churned your portfolio within large cap IT as well, as I've understood, in a meaningful way. My question is, I presume, right? So how are you choosing between these companies as well? Are you going out and choosing companies based on the trends plus the earnings numbers that they are posing? Because large cap IT has pretty much been homogeneous, so to say, save for maybe a Tech Mahindra, which has been an outlier.
Absolutely. So we find that our portfolio is getting more populated towards the mid cap space.
Okay.
And a lot of these mid caps actually are becoming large caps.
Hmm.
There are some very good marquee mid cap names. It's like specialty chemicals. Just small caps have now become mid caps. Even in the IT space, the kind of so for us the sweet journey is the transition from mid and small towards large towards the index. That journey,
Sure.
and very often these stocks will not be cheap, they will be well discovered. But the important thing is that if you continue delivering earnings, you continue delivering numbers, the market starts rewarding you. So essentially, we are growth investors. And we find that excellent growth is visible in a lot of these mid-cap IT spaces. And with time, they have all transitioned or knocking on the door of large caps. But we find that that is a very, very sweet journey, not just in terms of price, Neeraj, it's also volatility. You'll find that the kind of volatility they have is so much lower because returns by itself have to be looked at with even risk or risk in terms of volatility. So I not only am looking for good returns for my clients, I'm also looking for low volatility because sleeping well at night for my client and for me is also very important.
Very important.
That is defined by volatility.
That's true. Atul, a space that is really starting to show some numbers is real estate. And maybe they were a large portion of the index, if you will, in some fashion back in 2008. Since then, as you said, a 12-year bear market maybe finally coming back. And every month I see the numbers, city-wise, state-wise, company-wise, they all look very strong. What's your sense here?
Absolutely. I mean, I think what you see is a sector from where it was in 2008 to where it fell and made this massive 10-year kind of basing formation. And this sector is coming out of it. Apart from that, even, see some stock sectors like media. So you'll find that a lot of these sectors, which are almost through 10-year bear markets coming out of it. So real estate also is exhibiting that kind of flavor, that kind of move. Now, when we go and start looking at the numbers, we realize that the consistency that we are looking is slightly missing, or maybe it's a little early in the cycle. But what we find in our portfolio is a very overweight position to a lot of businesses that are related to real estate, which are suppliers to real estate. And we find that the sector of real estate may have its ups and downs, but home improvement as an area is actually a 5-7-year-old theme. And every reset has actually worked. In fact, demonetization was one of the biggest beneficiaries. GST, if you look at it, and even now post-COVID. So what you realize is that actually the larger trend is there.
Yeah.
And that is how we think, because we are not investing for 3 to 5 years or one quarter. So the volatility of earnings or lack of consistency yet established by real estate companies keeps me away from it. Again, there are a handful of them, and some are a little dodgy also. But if I go beyond that and look at the sectors or industries that are supporting it, let's call it home improvement. Wow, they've had a dream run. So here is what we look at. I'm seeing earnings, I'm seeing price movements, and I'm seeing low volatility. And that for me is what a long-term or a marathon trend is.
Interesting. Final question, Atul, because we've taken 30 minutes of your time already. But one final question. How do you approach, therefore, the index? What kind of trends does it show? I mean, do you believe that what you saw back in the last two instances, 2004 and then 2009, is something that we might see right now, a long period of sideways consolidation?
Absolutely. We started the whole conversation
on
that consolidative kind of phase. So I feel that is something that will come up. Now, obviously, these numbers will change because, as I said, this Fed meeting and what the Fed utterances are very, very important for the market, because that is something that can sort of swing global markets. And whether you like it or not, India is a part of that. I mean, you can look at the fact that uh, the US markets have actually had a very smart recovery. The S&P 500 on a weekly closed at a lifetime high. The Nasdaq is not very far from there. So you'll find that, and India has done extremely well. It's one of the best performing global markets. So you'll realize that we cannot get away from the bigger global trend. And that is where this whole, in the short run, this Fed thing is going to be a reality, is going to bring about a bit of swish. But in a bigger story, I would say a year or so, I feel that we would be in a consolidative phase. Kabhi khushi, kabhi gum is how I would put it. Could be the next phase or the next few months for the market.
Okay, so look at consolidation, but there will be ample winners to choose from to try and identify the right trends.
Certainly. And we've seen that historically. But it's not going to be that everyone's going to make money.
Of course, get your point. You haven't, sorry, I said the last question. I'm just wondering, you haven't dabbled or thought of doing anything in the crypto space, I reckon?
No, I find it very, very interesting. I think it's an opportunity of a lifetime. Unfortunately, the laws, etc., are getting formalized. And when you manage a little larger money or you want to play an asset class, you have to have clarity, because you don't want to do something and then the law comes to bite you back, because you're also responsible for other people's money and you don't want that. So I look at crypto with great interest, because see, the thing with crypto is that yes, there are no underlying fundamentals, right? Even commodities, there is a demand, supply, etc., etc. But with crypto, it's all pure demand and supply. It's flow of money. So how do you really analyze it? It is through charts. It is through technicals. So in that sense of the term, crypto is a perfect setup for someone like me who looks at price, who looks at charts and technicals, and who has discipline, because we know how fast they move. We also know that they can be very, very lethal. So for somebody like me, it's absolute core strength. Yes, I haven't done much in it simply because of the legality, but I think at some point even that would get settled. And I find that very, very interesting, because if you start studying the thesis or the logic behind it and the kind of players who got into it, today it's a market you can't ignore. If it's a small market, it's a bubble, it's okay, it will just create small pain. But today, the size, the market cap, the amount of money that has gone into this, or notionally or whatever, is too large. It's too large. You cannot ignore it, because with it, if it collapses, it will bring down the real economy also. So I feel that crypto is very interesting. A lot of Indians at a retail level are very, very active, but at a larger institutional stage, we are in denial, simply because we don't want to do something which is still lack of clarity or little gray. So hoping something comes out soon and can participate in that.
Wish you all the best for that. But wishing you a splendid Christmas and festive season and a great 2022.
Same to you, Neeraj, and have a great year, man. Take care.
Thank you so much. And viewers, thanks for tuning into this edition of The Talking Point.